Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing how automakers have been caught in the tariff crossfire. Talk about market chaos. Donald Trump's back and forth on tariffs with Canada and Mexico sent markets into a frenzy last week. One day they're on, the next day they're off. Investors just can't catch a break. No matter how this plays out, the uncertainty alone could weigh on markets until solid trade agreements are locked in. The auto industry is feeling the heat. Already dealing with slowing EV sales and a dip in consumer spending, now it's caught in the tariff crossfire. But where there's pessimism, there's opportunity. So let's dig into the auto industry's latest developments. But first, here's markets at a glance. What's moving markets? First up, US GDP outlook. Warning signs are flashing. The Atlanta Fed's GDP Now model has done a complete 180. It went from predicting 2.3% growth in February to now forecasting a 2.8% contraction in Q1 of 2025. That's a big swing. Weak consumer spending, slumping manufacturing orders, and trade uncertainty are fueling recession fears. Add in shaky bond markets and a potential government shutdown, and you've got a recipe for volatility. For investors, this means more market swings and growing stagflation risks, which is weak growth coupled with stubborn inflation. The economy isn't crashing just yet, but tariffs, inflation, and political uncertainty are making for a bumpy ride. Next up, we had German bonds taking a beating on the €500 billion spending plan. Germany just had its worst bond market day since 1990. Why was that? Well, the incoming Chancellor, Friedrich Merz, is shaking things up with a massive €500 billion investment plan for defense and infrastructure. With the US stepping back from NATO, Europe is being forced to boost its own military spending. Markets see this as a double-edged sword. On one hand, stimulus spending could reignite growth in the region. On the other, higher debt could limit how much rates can fall. Meanwhile, the euro is strengthening, making imports cheaper, but potentially weighing on exports. For now, investors are watching to see how this plays out. Next up, Eutelsat's share price rockets 650% on bid to replace Starlink in Ukraine. The EU is looking to replace Starlink's battlefield communications in Ukraine, and Eutelsat, based in France, is stepping up. The company already has thousands of terminals in Ukraine, but scaling to fully replace Starlink will take years. This isn't just about Ukraine. If the EU and US drift further apart, Europe won't want to rely on a US-controlled satellite network, especially one owned by Elon Musk. The battle over communication networks is just getting started. Next up, we had the European gas storage debate, stability versus cost. The European Union wants to extend its gas storage targets until 2027, but some nations, like Germany and the Netherlands, argue that rigid targets drive up prices. What's the compromise? More flexibility in summer months to ease market pressure while still hitting the 90% storage goal by November. For investors, this means continued volatility in European gas markets. If stricter storage rules do stay in place, energy costs could stay high. Next up, there's the Trade War 2.0, where metal markets are bracing for impact. The US just hit Canada and Mexico with 25% tariffs on most metal imports. Canada fired back with retaliatory tariffs and is even considering blocking exports of key metals like nickel and uranium. For investors, this means higher manufacturing costs and potential supply chain headaches. But it's not all bad news. Gold and silver prices are rising as geopolitical uncertainty fuels demand for them. Battery metals, though, remain largely unaffected since China and Korea are still the main buyers. And lastly, recession fears are growing as markets wobble. Trump's trade war is spooking investors, and this time there's no Trump put to cushion the blow. Treasury Secretary Scott Bessent has made it clear, Wall Street isn't the priority. The focus is on small business and consumers. Bond markets are pricing in multiple Fed rate cuts, signaling that investors expect weaker growth or even a recession. The odds of a US recession in 2025 recently peaked at 38%, but they're now sitting at 31%. Markets are still uneasy because that's much higher than usual. Higher tariffs, inflation fears, and a weakening dollar are all flashing warning signs. So now let's get into the main piece. The auto industry's outlook in 2025 seems like there's rough roads ahead. The car business has never been easy. Since 1895, nearly 2,000 automakers have come and gone in the US alone. Now, history seems to be repeating itself in the EV space as competition intensifies and some companies struggle to survive. Warren Buffett once said that instead of investing in automakers in 1900, the real money was in shorting horses. Picking winners in the auto industry is notoriously difficult. Consumers are fickle, brand loyalty shifts, and modern cars last longer than ever. Over the past decade, only a few automakers have delivered big returns. Tesla, up 1,800%, BYD, up 1,180%, and Ferrari, up 792%. Most legacy automakers have underperformed, and the once mighty German manufacturers are struggling to maintain profitability. So let's talk about these tariffs and what they mean for automakers. The car industry is global, with production spread across multiple different countries. That's why many vehicles sold in the US today are actually built in Mexico or Canada, using components from all over the world. Trump's proposed 25% tariffs on Mexican and Canadian auto imports aim to push manufacturers to bring production back to the US. But analysts point out two big problems. Firstly, setting up new factories takes years, and secondly, paying the 25% tariff might still be cheaper than manufacturing in the US, but that cost will be passed on to consumers regardless. Higher car prices could mean fewer sales, which isn't great for automakers. And with tariffs being delayed month after month, uncertainty is making long-term planning nearly impossible. While US companies are the most affected, it's still unclear whether European and Japanese automakers will face similar tariffs. One company unlikely to shift production anywhere is Ferrari. It famously manufactures all of its cars in Maranello, Italy, and despite strong earnings, its stock took a hit due to US tariff concerns. So let's check in on the EV market. Its growth is slowing, but it's still moving. The EV slowdown was expected, but global sales have held up better than many feared, largely thanks to China. BYD in particular saw a 33% jump in sales. Plug-in hybrid vehicles have also gained traction, rising from 30% to 38% of total EV sales last year. Why was that? Well, they help ease range anxiety and charging infrastructure concerns, making them an easier sell for hesitant buyers. Government subsidies have also played a big role in supporting EV sales. China extended its subsidies and Europe followed suit, but these subsidies aren't guaranteed forever. France has already cut back, and the US may not be far behind. So this raises the question, with less government support, are legacy automakers still all in on EVs? The answer is not exactly. Many are scaling back ambitious EV plans due to slowing sales and rising costs. Some players had too many EV models in development while their electrification divisions were still unprofitable. So what's the pivot? More hybrid models following BYD and Toyota's success. For traditional automakers, staying financially healthy is now priority number one. Strong balance sheets and steady cash flows are key in these uncertain times. So what's the insight here? You might find better value in the supply chain. The automotive sector is likely to remain under pressure until there is more clarity on tariffs. Even without this uncertainty, the broader outlook for most automakers is tepid at best. A quick scan of automakers on the platform reveals few auto companies with strong fundamentals, which just reinforces the industry's overall weakness. However, if you want to get off this automaker seesaw we're on, you might be more enticed by the brighter outlook for auto component manufacturers. Unlike automakers, these companies are less exposed to shifting consumer preferences and the high-stakes competition that often results in winner-takes-all scenarios. Their business models tend to be more resilient, making them a more attractive option in the current environment for those who want stability. While automakers face headwinds from potential tariffs and structural challenges, auto components companies could offer more stable opportunities. Try to focus on businesses with consistent demand and lower exposure to unpredictable market dynamics. You'll be able to assess that by looking at their past performance and future prospects on the platform, which we've added to the filters above in this screener. The best part is that you can save this screener example we've made above, and then you can make your own changes to filter down to any finer details that you're looking for, like dividend yield, low leverage, and plenty more. So right now, automakers are facing headwinds from tariffs, slowing sales, and an uncertain future. But for component suppliers, the outlook does seem to be a little brighter. And that just about wraps up this week's Market Insights. If you'd like to read the full piece, which goes into more details, we'll have a link to the article in the show notes. As always, if you have any feedback, please do let us know. We'll be back next week with more Market Insights. Until then, invest well.